Welcome to Daybreak Australia. I'm Haidi Stroud-Watts in Sydney.
And I'm Paul Allen. The top stories this hour. Asian stocks set to follow the dip on Wall Street on renewed concerns the Fed will keep interest rates higher for longer.
But Amazon shares buck the trend as its cloud unit posts its strongest sales growth in a year.
Binance founder CZ gets a 4-month prison sentence for failures at the world's largest cryptocurrency exchange.
And China's ruling Communist Party vows to explore new measures to tackle the housing crisis and hints at possible rate cuts ahead. That is certainly one factor that we're watching as we get into the start of trading over the next couple of hours or so. It is a holiday-thin session, of course. We'll get you to that in just a moment. But this is a setup, a pretty dire one when it comes to Sydney stocks. We're down by about 1.2% in the futures session. Fair value suggesting an early decline of over 1%, tracking those losses that we saw in the US overnight. Bond yields climbing too, of course. These concerns about sticky inflation and what we could expect from that hawkish pivot from the Fed starting to take hold when it comes to risk sentiment there. We are seeing futures really pointing to drops of over 1% really across the region. Kiwi stocks are down by about 0.4%. We had the labour market numbers showing that the jobless rate has risen to that 3-year high of 4.3%, so increasing some pressure there on the RBNZ. Chicago Nikkei futures looking pretty muted there as well, looking like a drop of over 1% when we get to the start of cash trading. And as I mentioned, a number of closed markets in play today. No trading in mainland China, Hong Kong, South Korea and Taiwan. Across the region, we're also seeing markets closed in Singapore, Indonesia, India and Malaysia as well as some of those other ones, Paul, on the screen there.
Yeah, as you mentioned there, a risk-off session expected in those markets that are open today. That's definitely what we saw in the US. And if we take a look at US futures as well, also a little bit weaker at the moment. You mentioned those US labour costs rising. It's really reinforcing this higher for longer narrative on the eve of the Fed meeting, and markets really seem to be front-running what's likely to be a hawkish message. We did hear from Amazon, the stock flat after hours though. First quarter profit did beat estimates. The cloud unit posted its strongest sales growth in a year. Take a look at oil prices, though, also slipping below $82 a barrel for West Texas, so that was a key support level. And we are, of course, watching now for a potential Gaza ceasefire. Well, let's get some more markets perspective now with Hebe Chen. She's market analyst at IG, joining us now from Melbourne. So, Hebe, as we look ahead to that Fed meeting, what's the chance that we're on hold now for the rest of 2024 as inflation just continues to look sticky?
Good morning, Paul. Good morning, Heidi. Yes, I think for the upcoming meeting tomorrow, the expectation is that will certainly be quite hawkish pause, as the market already been quite worried about based on the rate of the sea to date. But I think what the key message and key watching point from the coming meeting is how Jake Powell going to surprise the market, but not to shock the market. As what the major task that he have to do is to help the market to navigate the revision of the rate cut. In the previous meeting that the Fed still project for the 3 rate cuts by the end of this year, but now the market has been downsized that to 1 or even a none. So they are not going to make a decision in this meeting, but they have to prepare for the next meeting that they will tell the market what they are thinking about the inflation now, whether or not the inflation will keep pushing up and what they could materially impact on their projection for the rate cuts. So at this stage, market is only being sort of ready for only 1 cut, but will there be a chance for a none or even the rate rise is the market being most worried or concerned about.
Yeah, we've also had some sluggish GDP figures out of the US as well. Is stagflation something that you're starting to think about, and are you positioning for that?
Well, I guess that based on the market's response in the past week, we know that SP 500 got the best week in the year. That seems to, it's the scenario, or probably the perfect scenario the market is now pricing in, is that economy still stays okay, still above the water. The inflation that market is being come to terms with the fact that inflation will stay there higher for longer. But as long as the economy is still doing all right, I think the market will feel a bit of a relief that. But if we get into a certain point, for instance, in the Q2, we do seeing that the slowing down pace of economy is picking up its speed. I think that will be the real point, as you mentioned about stagflation, will be the next concern of quite critical risks for the market.
Taking a look at Hong Kong and China, right, what sort of comes next? Because if you take a look at the outlook for earnings, things are still looking pretty depressed.
Well, I think Hong Kong's story is a bit different. If we're looking back the past months in April, it turns out that Hong Kong's Hang Seng is the best performing index for the global index. It's jumping about more than 7%. And behind that is a huge push from the Chinese government, the policymakers trying to encourage more capital investor from mainland China to the Hong Kong market. I expect that will continue to be a big push and big forces to support the Hong Kong market in the months ahead. But of course, as you mentioned, the global environment is getting changed, as we're seeing in April as well. We do seeing the Japanese market used to be best performing in the first quarter, and now to be the worst performer in the Asian market. So I think that the pressure will definitely accumulate and keep the sky limited for how far the Chinese market and Hong Kong market could continue to rally. But again, I think that supporting there will be the one thing that maybe investor will feel still confident about.
Yeah, and in terms of going forward, there's been a lot of talk about, how you pick the sector winners given the broader macroeconomic weakness, right? And this chart kind of shows the projections that we see for the 5 heaviest weighted sectors across the MSCI China index. That dispersion, when you look at it, where do you see the winners and the room where you see still room for potential gains?
Yes, I think overall that if we base on the market's response to China's GDP in the Q1, that there's no expectation that market is now expecting a quite rapidly improvement in terms of the Chinese economy. While the EPMI from yesterday, the manufacturing sector seems to be quite a positive to expect a recovery there. I think that will be one of the potential source of a improvement, or as you mentioned about potential for the Chinese market. But on the other hand, I think technology-wise, given that China is now pushing so hard to its so-called the neo-productive forces, and that's the one that the China, from the top policymakers' point of view, that invests so heavily into that. So I think this is another sector that investor probably will be looking and keep their eyes on to, is any other support from the top policymaker will help this sector to continue recovered.
Hebe, just want to talk about the yen for a while. We have seen Bank of Japan accounts that suggest what we saw on the 29th of this month was in fact intervention. But considering what we were talking about the Fed higher for longer, the divergence in rates as well, do you think the Ministry of Finance and Bank of Japan are fighting a losing battle here? I mean, we've got the yen back at 157.70 right now.
Yes, I think that we keep to seeing that the number we probably unsee or rare to see it in this week. It appears that out past the 155 levels, now we're seeing the number keep pushing up. Now the people are talking about maybe 160 will be the line in the sand that they will start to making that materially or tangibly intervene. But I think that if you just purely based on what they said in the last Friday's Bank of Japan's meeting, I still believe they will be quite cautious to making any like a big move, that because Japanese economy do not seems to be that strong as what we expected to support a higher interest rate layer. So that changing the interest rate rapidly is definitely not something I think on the table for the Bank of Japan. Whether or not they will intervene subtly to keep it just right below 160, I think is more likely that applied for the months ahead.
Yeah, do you think the market's just going to keep on testing the Ministry of Finance appetite for intervention, though? What's your yen forecast?
Yes, I think it's very likely. What happened on Monday is probably due to the low of liquidities, and they're getting into a level that people are taking the profit away from the account. That's something that triggered a bit of the volatility on Monday. But I think as long as the US dollar, as you mentioned, the US dollar continue to pushing up, and highly based on what the Fed's stance, the coming meeting, and as well as the inflation data from the US, I think that pressure, the upward pressures will stay there. And yes, as you're right, I think the market will keep testing what is really the red line there for the Bank of Japan.
All right, Hebe Chen, IG market analyst, going to be staying with us. We'll talk a little bit about tech earnings in a moment, Heidi. But on that subject, what else are we watching?
Yeah, we were talking about China a little bit earlier, and it's one of the top stories that we're following today, with top officials in China committing to exploring new tools to address the country's prolonged housing crisis. The 24-member Politburo, led by President Xi Jinping, has agreed to make flexible use of measures to support the economy and research ways to deal with unsold property. That's according to the official Xinhua news agency. emergency. The meeting's readout also hinted at possible rate cuts. This is the first time since April 2020 that the statement has mentioned interest rates and the reserve requirement ratio. A Bloomberg analysis of the Bank of Japan's account suggests the central bank likely intervened on Monday to support the yen, the first since 2022. The BOJ reported an estimated drop of 7.56 trillion yen in its current account on Tuesday. This is much larger than the 2.1 trillion yen expected by private money brokers, suggesting intervention of about 5.5 trillion yen took place. The Ministry of Finance has refrained from confirming whether there was intervention after rapid depreciation took the yen to beyond 160 per dollar on Monday. Israel will wait for Hamas to respond to the latest temporary truce and hostage release proposal before considering to join ceasefire talks on the Gaza conflict. State-run Khan News said that the Israeli government is expecting an answer from the Iran-backed militant group on Wednesday evening. Under the latest terms of the internationally mediated proposal, Israeli forces have agreed to withdraw from parts of Gaza, according to Khan. Australia is tightening scrutiny of foreign investment into mining and refining of critical minerals. It's part of an overhaul of rules that also includes speeding up approvals in low-risk areas to boost economic growth. China's dominance in the critical minerals supply chain has prompted Australia to boost its industries by working with allies like the US, Japan and South Korea. And Binance founder Changpeng Zhao has been ordered to spend 4 months in prison for failures that allowed cybercriminals and terrorist groups to freely trade on the world's largest cryptocurrency exchange. While the sentence was far below the 3 years prosecutors had sought, the outcome closes a long-running probe for the Justice Department, which had sought to make an example out of Zhao to an industry rebounding from a slew of high-profile scandals.
All right, still to come, we're going to have some analysis on Amazon's earnings as its cloud unit posted strongest sales growth in a year. This is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Oops, we did it again.
We have a strong economy. Labor markets are tight.
We have to question, can the economy stay this resilient?
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The jobs market is not deteriorating.
How long can that story keep holding for this Federal Reserve?
The source of this strength, we could debate it all day.
The April Jobs Report, Friday on Bloomberg.
We see considerable momentum on the AI front, where we've accumulated a multi-billion-dollar revenue run rate already. You've heard me talk about our approach before, and we continue to add capabilities at all 3 layers of the Gen AI stack.
Amazon President and CEO Andy Jassy there on the earnings call. Well, shares in Amazon surging and extended trading after we saw that report of a solid earnings beat. The cloud unit posting its strongest sales growth in a year thanks to rising AI demand. Let's bring up Bloomberg tech reporter Spencer Soper for some analysis. And obviously it would have been a relief to see that result out of AWS. Does that sort of, I guess, soothe some of the disappointment when it comes to sales guidance?
Yeah, there was a lot of good news from the cloud division and a lot of hope going forward in the future for Amazon's performance through this Gen AI boom. That was really their talking points to investors. Was this has now become a multi-billion-dollar revenue run rate for us, and we see that continuing to grow. We're seeing customers take on longer-term agreements and bigger deals with us as they train these new models. And yeah, that did seem to carry the day over some, a little bit soft guidance for the current quarter, which they explained as, consumers still being pretty tight with their purchases, maybe buying lower cost items and more consumables, which tend to have lower prices.
Spencer, what sort of spending are we anticipating from Amazon in terms of data centers, and is that going to come at the expense of more cuts elsewhere?
Yeah, it's a great question. They did mention that. They didn't give absolute clarity, but they said that, data center investments in the first quarter were about $14 billion, and they expect that to be the low mark for the year. So it's only going to increase from there. They didn't give a firm figure, but they did hint that their spending will only increase on that. And then they said they're just kind of maintaining flat headcount through most corporate roles. Overall employment did go up a smidgen, and they said that's mostly frontline workers in their transportation and logistics unit, but that most of the corporate roles have been pretty flat, and they expect that to continue.
No hopes for that dividend, or the hopes were snuffed out, right? What's the cash trajectory looking like, and are they left with many options there?
Yeah, so it did come up directly. There was a lot of anticipation even before the earnings release, and some of that was fueled by dividends paid by Alphabet Inc. and Meta Platforms. And so investors were curious, will Amazon do this for us? And asked kind of like the philosophy around returning money to shareholders. And the CFO was pretty blunt. He just said, look, we always have prioritized, investing in growth in the business and paying down debt. Those are always things that will come first for us. And right now we see a lot of opportunity to invest in data centers, and we still have bills to pay from debt we took on during the pandemic to really build out our operations. So I think he threw a bucket of cold water on those hopes and dreams.
All right, Bloomberg tech reporter Spencer Soper there. Thanks for joining us. Let's get back now to Hebe Chen, market analyst at IG. And Hebe, I just want to pick up on some of the points that Spencer was making there, particularly around AWS, its cloud unit recovering strongly, and that really mirrors the experience of its competitors as well, Alphabet and Microsoft. Do you think this reflects a trend more broadly among the clients of those big tech companies that they're spending more on the cloud again?
Yes, absolutely. I think that sort of mirror the Microsoft story, that because of the AI being pushed, they help the cloud service to grow exceptionally. And this is 17% of the growth in AWS is actually the fastest pace in the past 2 years for Amazon. But on the other hand, if you from the investor point of view, I think that also reflect one of the growing trend is that the appetite for AI story is growing. Then now they said just a purely vision for AI will not to satisfy the investors moving forward. They want some tangible numbers on the paper to showing them how much they benefit from that. And taking away from that, what also been putting the more pressures from the rest of the Magnificent Seven if they can't deliver the number as robust as Microsoft and the Amazon on their AI development, and AI being put, the revenue number-wise, they've been pushed by the AI story. That will be a big pressure for them.
So we've got Amazon up pretty strongly so far this year, up after hours as well. The stock sort of hovering around those highs that we saw during the peak of the pandemic. Do you buy at these levels?
Well, I think if that you taking the Amazon, not just, I think that we have to change the view from the Amazon is that it has transferred successfully from just purely an e-commerce king to now we can probably call it a king of a crop. I'm not sure if Microsoft will agree or not, but they do solid, very, very solid to confirm their position as one of the market leader in terms of cloud services. That 17% growth in this quarter has helped the market to ease the concern that they have previously is because the market share has been so high that we're potentially seeing the growth been getting a quite moderate level, the low double digit, but they actually beat the expectation there, and the expectation for next quarter is even brighter.
Hebe, more generally, I mean, this is obviously giving another big lift for the Mag 7, but do you see the prospect of Fed higher for longer and potentially that being reflected across some of these other economies being much of a detriment to big tech at this point?
Well, I could say that if we're looking for the performance for the Magnificent Seven this year, we're already seeing this layer. We're already seeing the big gap in between, maybe just 4 and 3. We're seeing that Microsoft, Alphabet, Nvidia, of course, Amazon, they do having the extra boost from the AI, from the cloud services. But in terms of Apple and Tesla or Meta, if they don't have the actual forces to counter the economic slowdown, counter the interest rate will stay higher for longer, the downtrend for them will be probably, it's very hard to reverse for the year ahead.
I wanted to talk about Baidu, obviously in the spotlight with these conversations around Tesla and Elon Musk's visit to China. Tell us more about this hypothesis that we're starting to see some of these companies become gatekeepers for Western tech, right? And it's such a complicated landscape, but does that make it a little bit easier?
Well, in short, I don't think it's making easier. It's just that I think from this week's Tesla and Baidu's sort of partnership, there's a dual message coming from Chinese government is that they trying to convince the market or the global market is that they still keep the door open. If you want to come into Chinese market, we still keep the door open. Don't judge me on that. But on the other hand, they also enforce the message there that you have to play by my rule. And partnership with the Baidu or partnership with any other maybe big tech in China, maybe the new strategy, if you still want to stay in China, you still wanted to enjoy all the benefits this huge market could bring to you. And in terms of Baidu, they now position themselves as, they position themselves as they have the capabilities of help any like international tech players to meet with the requirement from the China's, either from the national security point of view and other concerns there. And on the other hand, they also benefit they could learn from the best tech advance for the global technology company. So I think that's a win-win. It's a big win for the Baidu as well, but for the technology companies, you have to learn the new ways to play it in the Chinese market now.
Hebe, before we let you go, we do have one more member of the Magnificent Seven about to report tomorrow. That is, of course, Apple. A lot of focus there on falling iPhone sales. If we do get a disappointing set of numbers, do you buy any dip on Apple? How confident are you of a recovery in future quarters?
Well, honestly, I'm not very confident. I think the expectation for Apple is both the earnings per share and the revenue are expected to drop in about 20%. As you mentioned, that's largely contributed by a decline in terms of the iPhone sales. They're just reporting a huge slump in the Chinese market, but out of China, the global-wise, the sales of smartphones is also declining as well. As I mentioned, I think that what the Apple really need now to make it or break it is what they're update in terms of the AI. Apple is predicted to have the AI premium in this summer. So if there's any new information they could deliver to give the market a little bit of a positive side of the surprise, that could potentially help them to see the bottom there. The Apple share price has been dropping about 14% this year. And whether or not they could coming up from that bottom will highly depends on is any updates on their new technology side.
Hebe, always great to chat with you. Hebe Chen, IG market analyst there. More to come on Daybreak Australia. This is Bloomberg.
All right, let's take a look at how we're shaping up for trading around the Asia Pacific this Wednesday. We do, of course, have a lot of markets closed, but a lot of significant markets still open, of course, including here in Australia. Futures, though, suggesting we're going to be a risk-off day today, off by 1.2%. Nikkei futures also weaker by 0.25%. As the old saying goes, sell in May, go away. It is the 1st of May, but data shows equities have an average gain in May of 0.93%, dating back to 1983. So proof there. Poetry, not an investment strategy. All right, look at the dollar spot index there, pretty flat at the moment. The yen weakening again, 157.71. Never mind intervention. Doesn't seem to be working at the moment. More to come on Daybreak Australia. Binance founder Changpeng Zhao gets a 4-month prison sentence for failures that allowed cybercriminals and terrorist groups to freely trade on the world's largest cryptocurrency exchange. Bloomberg's legal reporter Ava Benny-Morrison joins us now from Seattle. So, Ava, 4 months prison and CZ gets to remain a billionaire. What does this tell us in terms of deterrence?
That was a point that he had made, saying that he's never going to commit this crime or anything like it again, and that he should have probation because he's paid his dues, he's suffered in punishment in the way of being splashed all over the newspapers and in the media. But the Justice Department had argued that a strong message needs to be sent here to the crypto industry and to high-level executives all across America that this type of behaviour, even though it just seems like a banking law violation, isn't acceptable.
Are there meaningful implications for both Joel, 6 months after when he does get out from his prison sentence, but also for Binance more broadly?
CZ stepped down as the CEO of Binance as part of the terms of his plea agreement with the Justice Department late last year. He's still owner of the company. The prosecutor said today that he would still profit handsomely from the company, but he has said that he is focused after he does his 4 months in prison on a career outside of crypto. He wants to focus on his philanthropy and some different projects in the biotech industry. So we will see how that turns out and whether he is still involved behind the scenes of Binance or not.
Bloomberg's legal reporter Eva Benny-Morrison there in Seattle. Well, Bloomberg has learned that Tesla is eliminating most of its entire supercharger organisation that built a vast network of public charging stations in the US. Let's bring in Bloomberg's Global Business Asia editor, Peter Verco. So, Peter, what do we know about this and the ramifications?
Yeah, so it looks like Tesla has eliminated, as you said, almost its entire supercharger team. It's a 500-strong team in charge of rolling out its supercharger network across the US, including its senior director, Rebecca Tanucci. And these are on top of the 10% company-wide staff cuts that Musk ordered up last month. Musk then went on to X and said that they're going to slow the growth of the supercharger network. But this has ramifications beyond just Tesla, because most major US car makers are adopting Tesla's charging connectors in their cars. At the moment they're using adapters, but from sort of next year, Ford and GM are going to have Tesla's unique charging port built into their car. And we know that access to charging, particularly fast charging, is a key hurdle for people making a transition to EVs. And to wipe out this entire division, it's just going to, we've already had reporting from our reporters in the US that at Rivian, they're just sort of confused by what's going on and what this means for them. It means that these automakers are losing their main points of contact within Tesla just ahead of the summer driving season in the US when people go on holidays and stuff like that. So it just seems to be a bit more sort of confusion and turmoil at Tesla that's leaving some of its key customers, a bit in the dark.
And what are the implications for the actual supercharging network infrastructure?
Well, it seems that is going to slow down. And the supercharger network is the main charging network in the US. It's bigger than any of the other competitors. It's also a money spinner for Tesla. Piper Sandler have estimated that by the end of the decade, supercharging is going to be a $3 billion a year business for Tesla. And so if that starts to slow down, again, it just leaves some question marks hanging over what the plans are for the network here, how big it's going to be, and what kind of access it's going to be for EV drivers, not just for, as I said, not just for Tesla drivers, but across the whole EV spectrum.
Bloomberg's Global Business Asia editor Peter Verco there with the latest those changes for Tesla. Let's get to banking now, and HSBC CEO Noel Quinn is stepping down in what's seen as an unexpected move as Europe's largest lender tries to navigate deteriorating ties between China and the US. For more, let's bring our Asia investing editor Russell Ward. So Russell, this came as really a shock to a lot of people. What do we know about Noel Quinn's departure?
Morning, Heidi. Yeah, this was a big surprise coming during an otherwise relatively uneventful earnings season report. Noel Quinn said he's going to resign. He's going to stick around while they choose a new candidate. That process is already underway. There's process being led by Chairman Mark Tucker. So it's going to be a smooth transition, at least that's what Noel Quinn said. They're looking at internal and external candidates, but Noel Quinn, after almost 5 years, is pulling the pin on his leadership at HSBC.
Do we have any idea about who might be able to fill Noel Quinn's shoes, and what sort of challenges are they going to face to continue to grow the business?
Hi, Paul. Yes, as I mentioned, they're looking at internal and external candidates. So in terms of the internal candidates, people who could be in the running is the CFO, George Al-Haidari, who's been CFO since the start of last year. Other candidates as well, the wealth head, Nuno Matos, commercial banking head, Barry O'Byrne. But they could also, since they have the time, they can wait around to look for some outside talent as well. That could involve someone like Singapore OCBC CEO Helen Wong, Aviva CEO Amanda Blanc. These are just some names that have been touted around. And in terms of the challenges that they face, well, Quinn himself faced a really turbulent time with COVID. Obviously, that's been now past us, but probably the biggest challenge will be continuing that pivot to Asia and working in China. They're really committed to that market at a time, of course, of massive geopolitical tension between China and the US that HSBC and Quinn have been caught up in, and Quinn has sort of deftly managed that. So the new CEO will have to have that sort of that political kind of nous to be able to do that. The other thing they're going to have to do is sort of look at diversifying their business away from relying on net interest income. So that's like getting into more areas like wealth management and insurance. So, there are some challenges ahead for HSBC. I think Quinn's legacy is that he's sort of steadied the ship, and his successor will have to build on that.
And what a ship, right? This sort of turnaround, multi-year turnaround for HSBC has been glacial in a lot of ways, but he is living on a high. He's managed to, see through these record profits, fend off Ping An, for example. Things may not be as easy going forward.
That's right. I mean, as I mentioned, just taking interest income for as one example, he's ridden the wave of the massive rate increases, that environment that has helped the bank's lending income. But now, we're looking at rate cuts, albeit, delayed perhaps. But, that's just one area where there are going to be challenges with potential squeeze on net interest income. And then, of course, as mentioned, the geopolitical challenges. When Quinn came in, China was the market to be into. All banks were trying to get into there. China was deregulating the banking sector. Everyone was piling in. But now, of course, these banks realize they have to be in this market, but the market is slowing, and China has obviously immense challenges. HSBC has been caught up in the property debacle there, writing down a lot of assets in that sector. So, there are challenges going forward for a successor, that's for sure.
All right, Asia Investing editor Russell Ward there. Here are some of the other big corporate stories that we're following. Starbucks shares tumbling and extending trading after it posted its first sales drop since 2020. The company reported a 4% decline in same-store sales, with its locations in China seeing an 11% dip as half-off deals and new lattes failed to entice consumers. Starbucks also slashed its full-year revenue growth forecast to low single digits and signalled adjusted earnings per share may be flat. AMD shares also plunging in extended trading after the chipmaker gave disappointing forecasts for AI processors. The company projected that its MI300 lineup of AI accelerators will generate about $4 billion in revenue this year. Analysts were expecting twice that amount. CEO Lisa Su said the chipmaker is struggling to meet demand due to supply constraints. Huawei says profits rose nearly 600% in a sign that it's taking market share from Apple and other smartphone makers. It made $2.7 billion in the 3 months to March, marking the fourth consecutive quarter of profit growth. The phenomenal jump in earnings underscores Huawei's resurgence, and that's in spite of US sanctions. China Vanke is exiting non-core operations and divesting assets to boost liquidity. In a memo from a shareholder meeting, the company said it's adjusting its business model to focus on property development, real estate management and rentals. It's also pledging to reduce interest-bearing debt by $13.8 billion in the next 2 years.
Take a look at how we're setting up ahead of the start of trading here in Australia in just about 20 minutes' time, and also in Japan. Of course, a number of markets are closed for holidays today, but out of the ones that are trading, we're looking like a downward start when it comes to the action here in Sydney. Indicated downside of about 1.1%, really following the lag that we saw on Wall Street with that hit to risk sentiment, these concerns about higher for longer from the Fed, thanks to stickier inflation, are starting to play out when it comes to risk appetite. We also saw, in addition addition to that sell-off in US benchmarks, bond yields rising as well as that surge in the dollar as well. Kiwi stocks were down by just about 0.5%. We did have the labour market numbers showing that joblessness rose to a 3-year high. Interest rates are really starting to bite. They're cooling demand and curbing hiring in that market as well. So will really be seen as kind of a welcome sign by the central bank. It's battling still to return inflation to that 1 to 3% inflation target there. Taking a look at Japan, we're seeing a little bit of weakness, although mild compared to what we're seeing across the rest of the region. We did see some interesting results from Bloomberg analysis of central bank accounts, concluding that Japan did likely conduct that first currency intervention since 2022, judging by those numbers. So we continue to watch, of course, the yen, particularly as we see that big move, the index of the dollar jumping the most in more than 2 weeks in that Tuesday session, and how that plays out for Asian FX. More ahead here on Daybreak Australia. This is Bloomberg.
A Bloomberg analysis of central bank accounts suggests that Japan has probably conducted its first currency intervention since 2022 to prop up the yen. For more, let's bring in Garfield Reynolds, who leads our Markets Live Asia coverage. So, Garfield, the evidence piling up that was intervention that we saw on the 29th, but the key question is, with the yen now 157.72, did it work? Was it worth it?
Well, at the very least, it pushed the yen back from 160. It got within 0.03 of matching the low back in 1990. And if it goes past that, then it'll be the lowest since about 1986. And there's not a lot of ready barriers to hang on to. So from that point of view, it looks like something of a success, possibly a tactical success. And while you could argue that if the Fed somehow meets or exceeds the very hawkish expectations that it's facing, and also payrolls, depending on how they go, the yen could readily go back to those sort of levels. The reverse argument would be, well, if they hadn't intervened and you were starting from 160 or more yen per dollar, then who knows where you could end up. 170 would come into play pretty rapidly, and that's the sort of thing that would have a lot of impacts on Japan's economy, on the political situation, and you can see too that we've had this inversion of the previous situation where it used to be a weak yen was welcomed by the Japanese stock market because that helped a lot of the exporters that are key players in the Japanese corporate sphere. A weak yen is no longer being seen as unalloyed good news for corporate Japan.
The yuan, of course, obviously is another dimension to this in terms of how long the yen stability might stay as well. Some interesting comments we got from the Politburo, maybe a little bit more expressed aggression in how they plan to support the still struggling property sector and the broader economy.
Yeah, I mean, it as ever under Xi, it's always a very measured, push me, pull you setup. But they did sound more open to easing of various kinds, which probably makes it understandable. The news from this didn't come out until after we'd gone on a holiday, so there's no immediate pressure on the yuan. But it does seem as though it's going to make it harder and harder for the PBOC to significantly slow the yuan's decline in the face of a rampant US dollar. Now, if the US dollar pulls back, that's a different state of affairs. But on the one hand, Chinese equities in particular, we saw strong gains for property stocks leading into the meeting, and that those gains were validated to some extent because they definitely increased their interest in and work on how do we resolve the property situation. So for property stocks, for stocks in general, sounds like more support is coming. For the yuan, that dancing through the snowflakes task of the PBOC just got a few more snowflakes to dance through, and the the main task would seem to be to make sure that the yuan's march lower is a smooth one rather than a disorderly one.
One of the potential variables you mentioned there was, the possibility of a falling US dollar, though it looks pretty unlikely at the moment as we're on the eve of the Fed meeting. Markets seem braced for a pretty hawkish message here. What are we anticipating?
Well, a very strong anticipation that the Fed will signal that it's going to further delay rate cuts, and that indeed its initial guidance coming into this year, and then that was repeated in March, that it expects to cut 3 times this year, that looks extremely unlikely to occur. You would need to have by now, not just a noticeable slowdown in inflation, but an actual deterioration in the way the economy is traveling for them to look toward 3 rate cuts in the second half of this year. That's a pretty strong pace. And indeed, if you think Powell back in the beginning of this year was the base case seemed to be we cut in the middle of the year, probably June or July, on the way to these 3 cuts that we've penciled in. That looks very unrealistic now. So those are the sort of things you're going to want to look to him. There is the potential that the bond market has overplayed its hand and that Powell will end up sounding far more measured than the bond market is expecting.
Garfield Reynolds, who leads our Markets Live Asia coverage there. Well, Harvard University economics professor Kenneth Rogoff says the Fed is unlikely to act on possible political pressure coming from the US government. He also told Bloomberg that he expects long-term rates to remain elevated for years to come.
It's not going to work very well. I mean, it's going to be obvious that it's not working. If you take away Fed independence, investors are going to get jittery, inflation expectations are going to go up, the dollar is going to tank. So happily, for better, for worse, maybe, I think markets will throw a pretty cold bucket of water on the president if he tries to do that. I don't think he would go to that extreme, but it's clear, he wants to be disruptor in chief, and it probably irritates him that Powell gets so much attention at his press conferences.
So markets there would apply the brakes in that scenario, which, of course, still being reported out, details unclear, so we won't go too far into the hypotheticals. But let's talk a little bit more about real interest rates. If we do enter into this environment where you have these episodic spikes of inflation, what would sustainably higher real interest rates mean for this economy when you think about the potential ripple effects?
Well, I think it really comes in the cost of borrowing for the government, for individuals. So remember, inflation's also driving up tax revenues. It's also driving up wages and salaries. But the real interest rates, they're there to stay. They're the wedge between the two. And this world, there's this period where you were just a sucker not to borrow as much as possible, whether it was to buy a larger house, whether it was to fund new government programs, et cetera. And I think, we live in a more normal world now. I'm not saying I'm telling you what interest rates are going to be for the next 20 years, but what I am saying is I think on average, they're going to be a lot higher than they were after the global financial crisis.
Ken, one last quick one, if I could. What does it do to growth if we have long-term interest rates?
Well, we've had long-term interest rates a lot higher for a long time and had better growth than we have now. It sort of depends on what's going on. I think to the extent it's driven by huge government borrowing, private borrowing, it's clearly a negative. You're just paying a risk premium to borrow. To the extent it's driven by AI and productivity and wondrous new technologies, then obviously high rates just go hat in hand. Maybe there's some of both.
That's Harvard University economics professor Kenneth Rogoff speaking there to Bloomberg's David Weston and Katie Greefield. Now, you can watch us live and you can see our past interviews on our interactive TV function, TV Go. There you can also dive into any of the securities or Bloomberg functions that we talk about. You can also become part of the conversation and send us instant messages during our shows. This is for Bloomberg subscribers only. You can check it out at TV Go. This is Bloomberg.
All right, taking a look at the markets, and it is a holiday-themed session across Asia, but we are just a few minutes away from the start of the staggered open in Australia, looking like starting off on the back foot there, looking like downside of over 1% when we get to the start of trading here, with some downside coming through from New Zealand as well, with the jobless rate rising to that 3-year high in the latest data from the first quarter. Employment unexpectedly falling as well is really the impact of high rates starting to curb demand. That will be welcome news in a sense for the RBNZ. And of course, so much of this has just been the risk aversion that we saw in the final stretch for April across the US markets. Right now, we're looking at options suggesting that traders are now expecting the biggest Fed day move in the S&P since 2023. That's according to analysis from Citi. And that should be quite interesting because what we are expecting, of course, from the Fed poll is they will keep rates steady for a 6th straight meeting. And more importantly, that signal of no plans for cuts in the near future after inflation, as we know, continues, not just inflation, but so much of the data continues to hold up well.
Yeah, higher for longer definitely seems to be the well-embedded narrative at the moment from the Fed. That's going to support the greenback. You see that the dollar spot index rising. A couple of interesting currencies on that board starting at the bottom. The yen, well, that's weakening again, 157.71. And we have more evidence that the Bank of Japan probably did conduct intervention on Monday. We've got a BOJ report from yesterday that its current account's probably going to fall by 7.56 trillion. We were expecting a $2.1 trillion reduction, so that suggests an intervention of about $5.5 trillion took place. But was it worth it? Well, the yen weakening again. Also a little bit weaker, the Aussie dollar, just below 65 cents US. We did, of course, have CoreLogic house prices out of Australia coming in as expected, 0.6% increase in April. Just a reminder, a lot of markets closed today. Those include mainland China, Hong Kong, India, Indonesia, Malaysia, South Korea and Singapore. Others there on your screen. Market opens in Sydney, though, next.